some people may call it a trading range. The range is really determined by how big of a range you have. If you have a wide range, for example, like the stock indices are trading, then you want to try to take advantage of buying the support and selling the resistance. Some markets end up in very narrow ranges, and traders prefer to wait for breakouts of those types of patterns. So not only do you want to watch how the rectangle is developing, but you want to look at how wide the support and resistance lines are. Wide lines typically mean sell rallies, buy dips, and tight ranges usually mean that you're waiting for a particular breakout. So we'll go to the live chart again and see if we have a rectangular formation come up. And we did have a Euro British Pound here come up earlier in the morning. I'm on U.S. time, by the way, so AutoChartist, you can set this at various time frames up here in this time zone section. And also, just to recap, I'm looking here at the chart pattern section, and I have created various lists in different categories on this side. If you have AutoChartist right now, you may not have the same settings that I have, but I will show you that by the end of the session. So we're looking right now at a Euro British Pound, and again, it's a 240 minute, which is a very good time period to work with, and you also have 148 bar candlestick length, which, as I said before, is important. If you can get high length combined with a long time period, you're giving the market a chance to show itself to a lot of eyes out there, and that may mean institutional or bank or basically bigger money than, say, an individual trader. So if big money can spot a pattern just like you can spot the pattern, then typically they're going to react to these patterns, and there's going to be good volume and good volatility to take advantage of. So in this pattern, we had a pretty decent initial trend here of 8 bars on this down move. So it started down when it began, and we had very good uniformity and clarity on these swings. So we have well-established support and well-established resistance, particularly this resistance, which showed several tests before the market made its final decline. Now inside these channels too, you want to watch this particular move here. Okay, oftentimes when you get a market coming down from a top into an area here that's about the middle of the channel, the final rally will fail or stop about halfway to 61% of this last breakdown. And when you get this secondary lower top, that tends to be a key indication that the market is poised for a down move. So what we're looking at here, if I blow this up, is you'll see that after that secondary top was made, the candlestick started getting bigger, volume started getting bigger, volatility started getting more active, and the market then finally broke down through this pattern, and it seems to be headed towards this target zone if momentum can catch up. And this particular indicator, there's nothing fancy about it. I just used a simple search for a channel, for my channel patterns, and this was how the rectangular pattern was set up. You have your almost parallel support and resistance lines, and then finally you get the breakout. Now, as I was saying before, if you're a breakout trader, then you'd have to wait for this market to break support, and you're looking for the move from this breakdown into this target. Whereas swing traders, if this pattern is identified as an emerging pattern, then you'd be able to get the signal a lot sooner, and you can use support and resistance line to make your trading strategy. It doesn't look like I can search here on emerging patterns, and I can see if any of these rectangles come up, and it doesn't look like I have any emerging patterns right now in a rectangular chart. I do have some emerging patterns here, and I can show this Canadian and this Hong Kong dollar. I'm not sure what's going to come up here, but you can see what a emerging pattern looks like. It's still within the parameters of this support and resistance line, and the market tests support, rallies to resistance, and then tests support again. So traders, as long as the market stays inside this channel, you may have that rhythm where it goes from support, resistance to support, back up. So you can trade the zigzag or the particular move onto infinity as long as it stays inside that range. Okay, so that covers the rectangle pattern. Now another pattern that we look at, consider to be a channel pattern, is the flag. And you can see too, that's got a slight diagonal, but the lines look parallel. Okay, now the opposite of the flag is, say, the pennant, and the pennant's going to have similar movement, but the pennant's going to come to an apex like a triangle. Belongs in the triangle family. So when you see when AutoChartist identifies a flag pattern, again, think of channel pattern, and think of it as a pattern that you can trade as a swing pattern or as a breakout pattern. Okay. Now the other thing is, all these channel patterns are usually categorized as trending patterns, meaning you can clearly see trends inside those inside those parallel lines. And the triangle patterns are the non-trending patterns. And that's another webinar that we do where we talk about those types of patterns. So there's your flag. It's usually a shorter version of the longer channel, but it has many of the same characteristics. So go back to our live action again today, and we'll see if any flag patterns came up. And it looks like these patterns are so long, the length of these are so long that it doesn't look like you have a flag pattern completed as of this morning, but it doesn't mean we can't have one come up later. So right now we will move on to look at another pattern in this series of channels, and that is a double top. A double top is, again, very close to the rectangle in that you have two tops inside here with a point in the middle which represents the change in trend point. And in a double top formation, you do have pretty close to parallel lines. If they're exact tops, then you're going to have a very straight horizontal line. Sometimes you'll get a top. The second top will be a little bit shorter than the first one, and sometimes it may be a little bit higher. But all in all, it represents, there seems to be a very strong channel formation formed between the tops and this apex here of this particular pattern. And once these tops are made, it actually gets confirmed when this bottom is broken and the market drives lower. So that is that's a very good pattern. A lot of people like to jump the gun on that pattern, and they tend to try to work with get in a little bit earlier, and only to find themselves disappointed. So it's very important that you establish some pretty solid rules when working with the pattern of the double top or double bottom pattern, because you want to get that confirmation. So this morning, on a 15-minute chart, we did have a double top come in on the Australian US dollar. Now this took a little bit of time to form. You can see that there's a wide range in here, and the distance between these two tops help clarify the double top formation. Usually when you work with a double top, you want to have some distance between these two tops to give you a clue as to its strength. So when a person sees this top and then a break and then a rally back up, if there's a good distance between the two, then typically that means that the selling at this point is serious, because traders have had a long time to look at this resistance point, and by their action they have basically demonstrated the strength of that particular resistance point. Now here's where the market fell through. And as I said before, with channels you tend to get wide ranges. And if you get a wide range, oftentimes by the time it breaks through the support, in this case, it had traveled such a long distance that it just loses momentum. So you may want to watch for a market that, like I said, comes down. Oops, turn my screen blue. Comes down and then retraces and then comes down again. That's like a slingshot effect. Markets that go straight down from resistance to support seldom go through the support line the first time, because they just run out of sellers at that point. So here's a case where the market momentum slowed down.
James, Erica, sorry
Yes.
to interrupt. Can I quickly ask you a question, just to clarify this?
Yes.
So are you saying that the traders can actually expect a potential pullback like this, so that if the distance between support and resistance is quite big, that we can actually expect there's a chance of a pullback like this? And
Yes.
not actually almost get into a swing trade?
Yes, when you're working with channels and you get a wide support, you get a wide range, the market tends to oftentimes will go through support and it'll be oversold at that point. And so you don't get that follow through. In other words, traders have seen this move go down and they were asking themselves, why am I selling this thing so far down? And so what happens is the market will retrace and then regroup and start again.
So what do we do in that situation? Should we enter the trade, or should we be cautious first of all about entering the trade? And if we did, should we just stay in it and wait for it to come back down again?
Well, yeah, what you do is when you're trading a breakout, let me tell you just to clarify, if you get a signal on, say, an emerging pattern up here, then your initial stop should be above a swing top. Okay, when you start to sell weakness, you can't use, you have to use a quicker out. In other words, if you're looking for momentum, if momentum stops and the market goes back up over the your entry point or back over the support point, the best way is just to get out of the trade at that point. Otherwise, what you risk is a big retracement like this and then another move down. So I don't know of a lot of people that want to take this kind of heat. So it depends if you're trading swing or if you're trading momentum. Even if you're trading from here down to here, you should have some kind of a trail in there that indicates that the momentum has stopped and that you should start all over again. But the main thing is watch the size of these ranges when you're getting the breakout. That's the key. Is you don't want to.
Thanks for clarifying that.
Yeah, you don't want to sell into an oversold condition. Okay, here's another example of a double top. And again, you could see that this had a little bit more momentum, but you had a shorter distance, but you also had a big candlestick when it went through, and it still rallied back up and tested this area and then came back down to the target. So that's one of the characteristics of channels. Triangle patterns, on the other hand, because they've already compressed inside of a triangle, when they get a breakout, they tend to be a little bit more solid and volatile. When you're dealing with channels, especially when there's a big distance from a top to a bottom, you tend to get this reaction here. Okay, so that's one thing to know. The other thing is you want to pay attention to is whether, and I'll talk about this in a few minutes, is whether it's a reversal or a continuation. This pattern was strong going up into support. So you want to make sure that you end up with, you pay attention to whether it's continuation or reversal. So in this case, we had a strong up move, and then finally it broke through, and and then continued on to its target. So a lot of that has to do with the strength of the pattern.